What I'm going to share is pretty much on a yellow pad. You can't quite squeeze it all onto the napkin, right? But we call it the cylinders of money. And what we're really doing is we're looking at different cylinders, call it asset classes, places that people can save money. And we're looking at them from four elements: contributions, accumulations, distributions, and trade-off. Now we're going to start on the first cylinder, which is qualified money. We have pre-tax contributions. It accumulates tax deferred. Distributions, of course, are ordinary income taxable. And trade-off, you can't get at them till 59 and a half. And then at RMD age 73, you have to start taking them. The next cylinder that people usually start to save money long-term is in a non-qualified portfolio or non-qualified money, where you're putting in after-tax money. It accumulates with tax, it distributes with tax, and it's liquid. This is a wonderful account until you get to somewhere between $250,000, $500,000 of size, and then the tax freight of the accumulation and the distribution starts to really penalize your clients. So we start looking for other things. Nate just mentioned tax-free bonds. How do they work as a cylinder? It's after-tax contributions, accumulations are tax-free, distributions are tax-free. But a trade-off, it's somewhat liquid. And Nate, you made a good comment in there. Does it really keep up with inflation? Barely. And kind of what that vehicle does, right? If you're in a high tax state, people in the Midwest around Minnesota, as an example, munis can still look pretty attractive. Next cylinder, non-qualified annuities. Some people like them, some people not so much. Bottom line, here's how they play out here. Contributions are after tax. Accumulations are tax deferred. It's a power of that whole deferred annuity concept. They are tax favored when the money comes out, and you basically can't take them until 59 and a half, but there is no 73 RMD age. If you just want to let them grow and become a wealth transfer vehicle, you can. Let's look at the taxation on these. It's called last in, first out, or LIFO accounting on non-qualified annuities. Let's say you put in 100 grand through the years, it grew to 250. So you've got $150,000 of growth and you want to tap into it. Well, last in, first out means you're taking the growth out first, 100% income taxable. You don't get to remove that after-tax basis, if you will, or tax-free, I should call basis, until all of the gain has been removed. As you are aware, if you understand annuities, you could annuitize it and spread that gain out over a period of years. But last in, first out accounting. Back to the cylinders. How about real estate? Real estate can be really looked at two ways. First way is kind of your buy and hold, buy the cabin up in the mountains and just hold on to it. The other one is your investment real estate, rental income, that kind of stuff. Well, we're going to use the buy and hold strategy, the cabin in the mountains. So you're basically looking at contributions being after tax, accumulations being tax deferred, distributions being taxable but as capital gains, and like the tax-free bonds, it's kind of liquid. However, I own property in Florida. We bought a house in Florida 4 years ago, and then we just built a house. Well, this is what happens with real estate. It's kind of illiquid at times. It's become a rental for us. Welcome to being a little upside down, right? But let's talk about life insurance, because this really is a very attractive tool if it fits into your numbers in your portfolio. So let's start off how people purchase life insurance, or sometimes what I like to call how it's sold. High death benefit, moderately growing cash value, difference between those we call the cost of insurance. If we are talking about an alternative asset class, we do not want to design our insurance this way. Rather, we want to design it with a very low death benefit that grows, that gets pushed up by a very fast growing cash value. The difference again being your cost of insurance. Don't do it this way. Do it the side on the right, right? But when we can prove the cost of tax of other vehicles is more expensive than the cost of insurance, then it becomes an idea, right? So let's grid this out. Contributions are after tax. It accumulates tax deferred. It grows, or I'm sorry, it accumulates tax deferred, distributes tax free, and it is liquid, but you need to have 7 to 10 years of time on your side for that tax deferral to really make out. As we all know, insurance has fees and charges. And if you do one of these plans for 5, 6 years, you're not going to have enough deferral time on top of the fees and charges of the insurance to have this pan out. But if you're in there for 10, 15 years, the math is really wonderful. So let's look at the tax treatment. It's called first in, first out with life insurance. Same 100 grand you put in, grew to 250, got $150,000 of growth, and you want to take out 200 grand. You get to take out your basis first, tax-free return of principal, and then on the growth, you're actually taking a loan on your own money. The real why this works, it's kind of like borrowing money and paying yourself interest on your 401k if you've ever had that option. This is what we call a wash loan. The carrier will charge you 4% for loaning out the money. They'll credit you back the same 4% contractually guaranteed, so that there's a 0% cost to loan out your own money. So back to the cylinders. Which one of these cylinders is best? And literally, when you're in front of a client and you ask them this, they go, I don't know. Maybe it's a life insurance one. Maybe it's something else that they're doing. My argument has always been, I think the best one is the one on the left. It is so good that the IRS limits how much you can put into it. But it's really about this. It's about that third row. What are the distributions? Wouldn't it be neat to get out to retirement and have some of your monies being, I guess, 100% ordinary income taxable, some of it being capital gains, some of it being tax-free and tax-favored, and literally having money in all of these cylinders. When I draw this out on a yellow pad with you as your advisor and your client, you and your client as the advisor, say that's the right way. What we typically do is right on the top of each of these columns, we write in how much they have in each one of those cylinders so they can visually see it, right? And then here's what it looks like. Cost of tax versus cost of insurance. So we need to deal with underwriting. On a scale of 1 to 20, some carriers go A to Z. So you think that through. Table 1 or Table A is perfect health. Table 20 or Table Z is uninsurable. If your client comes in at Table 3, can we design a plan such that the cost of the tax is less than the cost of the insurance in that relationship? And again, when we can prove this mathematically, then that column on the right-hand side becomes part of a recommendation for your client. So that's the quick yellow pad presentation. I love what Nate did earlier. Sometimes it's just a T chart or a couple buckets, and you're talking about all the tax benefits. This can be a wonderful tool.